So like this is the danger zone. Do I look like a screen demon?
So you literally have to go from here to,
So,
there's no in between. Tally, what do you think about the current economic state of the US? Oh my God. Or if you just do it this way. Oh shit.
Hey, hey Tyler.
Hey Tyler, I had a question for you.
I could be like,
Let's just take the glasses off.
It's not a bag of chips, Tyler. No ruffles. Get it? Bag of chips, ruffles.
Just get out of my house. Hey guys.
Hey guys.
How's it going?
This is the Thymble podcast. We're going to talk to you today about some really interesting stuff that's going to help you on your financial journey to becoming independent with your money. Last episode we talked about...
No introductions?
Oh, well, yeah, that's true.
This is Ben Witt and Tyler Letch here today.
Well, which one's Ben Witt? I'm Ben Witt.
I don't know, I've lost track.
I'm Ben Witt, this is Tyler Latch. And yeah, so last episode we talked about stocks and we talked about just some general financial advice, but today we're going to focus down on another kind of investing.
To build that portfolio that we were talking about.
Build that portfolio that we talked about. And that, the first thing we're going to talk about is bonds. So, you know, first of all, I think we just got to establish what is a bond. That's the most important. Then we can talk about kind of, you know, what are the advantages of putting your money in bonds versus other forms, and also like how can you utilize multiple forms of investment. But we'll get more into detail on that at a later podcast. But so first, Tyler, how about you give me like a most basic definition of what you'd say a bond is?
So a bond is what we call fixed income essentially, and so it's this idea that you're getting recurring payments called coupons from this investment device that we're putting our money into. And so we'll see that maybe monthly, maybe quarterly, we'll be getting these returns, and who issues a bond is large corporations and governments. And it's primarily for the means of debt fundraising for them. So they want to see money coming in that they can't necessarily pay out now. And we're the ones that take on that risk for them, and in return get those coupon payments over time as they pay us back.
Sure. So I mean, right off the bat, we see the big difference there is that when you buy a bond from someone, you're not getting any ownership in the company, right? It's not equity. So that's something that is, you know, we got to make sure that we know the difference between. You know, you can't, there's no like majority bond holder, like where you're going to be an owner at that point. But yeah, I mean, the way I like to think about it, just helps me think about it, is it's kind of just like a loan. Eyes where?
No, our eyes were like this last time, actually.
I mean, I like to think about it as basically like a loan from these companies, or that we give to these companies as investors. And you know, they have to not only pay us back the coupon payments, which are not like your grocery store coupons, obviously. But
it used to be physical coupons, but now.
Yeah, sure. But now everything's electronic, so I mean, you don't have to worry about holding on to those physical. I feel like I always used to see the idea of bonds like grandparents would buy bonds for their kids a lot. Like that was something I think that was pretty common. But we're not really talking about that sort of thing. Like we're not talking about like my grandpa got me a Civil War bond and now it's worth, you know, back in the day it was worth $10 and now it's worth $1,000. How about, like, no, like it's different, right? We're talking about, you know, maturing, and we'll talk about what maturing bonds mean. But you know, you buy a bond, you pay the money to the company, you're going to hold on to it for a certain period of time, and you're going to make money off of that. Talk about some of the things like to do with risk, because we've talked a lot about how, you know, being a risk adverse person or being someone who's more risky, you know, how does that play into your investing? So how would you say that risk comes into play? You kind of mentioned it in your definition, but how does risk really come into play when we're dealing with investing in bonds? So
on behalf of the investor, bond is definitely backed a lot more than it is, you know, your equity investment, because there's no guarantee by the company for an equity investment that you're going to get your quote-unquote return. You're investing as a shareholder and owner in that, and however it goes from there is pretty much how you and the rest of the shareholders dictate that. Sure. In the event of a bond here, if you want to understand the safety of these, a good way to start doing that, and again, they are much safer than equity, but to start understanding and reading about that, they're rated all different ways, AAA, BBB, all that sort. You can go on to things like Moody's, Standard & Poor's. They'll all have these bond rating agencies out there to rate the corporations, and especially once you get into government, you're more than backed by most municipalities and especially the United States government. A lot of foreign investors as well like to invest directly with the U.S. government as opposed to their own governments, because the chance of default is almost none. FDIC backing is a big thing for us. But nonetheless, for the corporations that are a little bit more risky than these municipalities and government entities, then you can go on, you can see, AAA is the highest rated, very few and far between get that, or A double plus or whatever it was. But nonetheless, that's a good way to start distinguishing, among those different bonds.
So these ratings are kind of like the credit score of these firms.
Exactly.
So it's like saying, hey, we can trust these guys to pay you on your bonds, versus lower rating, you never know, they could default. And then you mentioned countries as well. Yeah, I mean that's another key difference I think, right, between equity is that it's not just firms involved in this investment, it's also governments, and that's a whole another thing that you can look into. And you even mentioned that a lot of people, borrow or buy U.S. bonds because we're relatively safe.
That's not just the backing of a firm's cash or whatnot. It's the backing of the entirety of GDP and your geopolitical environment. So it's a whole different spectrum of investing.
Sure. Yeah. Absolutely. What were we talking? So we talked about. So we talked about the risk from the investor standpoint. What's really like how does the risk how should we look at the risk from the corporation or even the government's point of view? Like, are they, what's the risk look like to them?
So in this case, again, unlike equity, equity, another owner comes into play and they now have voting shares and they can take hold of part of this company. There's no obligation to pay them back unless you're in the sort of dividends and, if you end dividends over time, if you're a firm that constantly pays dividends and suddenly cut that, it's a little more worrisome, but it's still no obligation to pay those dividends. But in this case for debt, we are obligated to pay it back because we're taking out that loan, we're getting this lending from other people, and in turn we have to pay that back or else it's going to hurt credit score, it's going to hurt our ratings and our publicity in front of all our investors.
So if you're really a risk-averse person, like if you're an investor and you're not into very risky investments, a highly rated bond is a pretty safe investment from yours because you're pretty much guaranteed to get your money back. So you get those coupon payments and you get the money in the end. So we're talking about buying bonds, but what does it actually look like to buy a bond? And I'll talk a little bit about this. So the pricing of a bond has to do with a few things, right? So we have the par value of the bond, and generally it's like $1,000 is generally the par value of a bond, right? And so you have that $1,000, but you're not going to be paying $1,000 most of the time. Like you can, it's possible. But
if you get it on issuance.
Sure, exactly. So if you get on issuance, you can pay $1,000. But let's say you don't, and so you're buying that bond from someone else. What starts coming into play is interest rates and the coupon payment amount. And we're not going to go into too much detail on interest just because I don't think it's really necessary to completely understand it. But basically, if your interest rate is going to be higher than your coupon rate, that bond is actually going to sell at what's called a discount. So that's going to be any price that's underneath the par value. So it could be anything from $999.99 to $800 or whatever, and vice versa. So if your interest rate is lower than your coupon amount, then that's actually going to sell at a premium. So it's going to be any price above your $1,000. Tyler, why would I buy a bond at a discount? Like, what would be the reasoning behind that? Because it sounds to me like, well, shoot, if it's cheap, what's wrong with it?
Exactly.
Is that the way to think about
so it's all on how you want to gauge. So like you were saying, there's that coupon rate that's fixed, it's always there, but it's the interest rate of the markets that you really want to gauge and understand, and they're tagged to all number of different things. But nonetheless, if you believe, so we're going in at a discount here, you're getting that for a lesser price, but that's because the cash flows are going to eventually discount to the price that you're getting. So you bought it, well, it was out there at one point at $1,000, now you can buy it for $800.
Yeah.
So if we see the interest rate continually go up, that $800 is suddenly going to be worth $700, and you're going to sell at $100 loss. However, if we're believing and we are able to gauge that maybe interest rates based on what the Fed's saying or whatnot are going to start going down, then we might be able to toggle on there and see maybe it goes from 800 to 900, and there we got that $100 increase that we can capture in our pocket.
Yeah, so you're kind of hedging your bets. You're saying, well, exactly. I think the interest rates are going to go up.
It is. That's where some of the risk comes into this.
Yeah, and I want to talk about, you know, where do we look to maybe decipher what is going to happen in interest rates. Obviously, no one's a seer, no one's a prophet. They don't know exactly what's going to happen, but there are places we can look. Why would I buy a premium bond?
Why would you buy a premium bond is essentially the exact opposite. So if we see that interest rates are going to start going higher and higher, then we're going to be able to capture that profit loss.
So it's like looking at the positive trend and saying, oh, this is growing. I think it's going to keep growing, so might as well get in on it while the iron's hot, right? So yeah, so you mentioned when you're talking about the interest, you mentioned the Fed.
Yes.
So can you talk a little bit more about that? Like, what are we looking at when it comes to, obviously we don't have to explain what the Fed is and all their history, but just when it comes to interest rates, why are we paying attention to what they're saying?
So a big part in what they're doing, and especially if you've ever heard the term LIBOR, the London Interbank Offered Rate, is what it is.
Which I'm sure all of our listeners have heard of.
They gauge essentially what the Fed does in a number of the top, I think, 15, 20 banks around the entire world, and they're actually looking to phase LIBOR out eventually. But for right now, this is what most discounts are based off of, most interest rates are based off of. They all come together and gauge the economic spectrum out there, and gauge the buying ability of, you know, corporations, of smaller governments out there, of the entire population of people. And then they essentially encapsulate that all in what we call this interest rate, or LIBOR, or, you know, the federal funds rate, or a treasury rate. We hear all of these, and essentially they're all pegged and underlying to what economic conditions are and what we think buying possibilities are for the future.
So they're trying to be the watchdogs. They're trying to say, this is how the world's doing, and so because of that, we're going to set the interest rates at this point. Okay, and so we need to pay attention to what they're doing. I mean, obviously we can't, you know, what they do is what they do. So we just have to be able to respond and maybe anticipate what they're doing. I mean, if you read the news, you know, like if you look at any publication, Wall Street Journal, New York Times, whatever, if you look at their finance section, you know, you're going to see articles about the Fed is talking about raising the rates. You know, and that's because, you know, the rates have been so low for, you know, quite a while now, almost, well, I guess a decade now, right? Ever since the 2008 crisis, it's been pretty low, and there was, you know, pretty good reason why they had them low. But because we're, you know, in a better economy, they've been saying, okay, it's time to raise the interest rate. So since interest rates have been so low, I mean, bonds, you know, have been a pretty good thing to invest in, because your coupon payment is most likely going to be higher than your interest rate. Let me think.
That is nowadays. Back then, when it was artificially low, you're not getting much return whatsoever. But the reason, you know, they're keeping it artificially low is so you can take out those loans at those lessened interest rates. Now that we're starting to see it come up a little bit, and in lieu of maybe what a lot of people are seeing is a, you know, future economic crisis in the near future, you might want to start investing maybe more in bonds now to capture that difference.
Sure. Okay, cool. Yeah, that's good. It's a good tip. I mean, that's a whole, you could talk forever about the impending, if you think there's going to be
but that's also how you want to start to look at that gauge. So say you can buy it now at a pretty decent price because the discount rate's high, but then suddenly interest rates start to drop, then it's going to go up and you're going to get larger return on that.
It's true. And you know, I guess it's about how much of a doomsayer. No, I don't know, but yeah, everyone talks about that for a long time. What else?
So let's say Germany invests over here and looks to issue their debt in the United States to start raising money over here. Or we could do it vice versa. The United States raises in Germany. And a lot of that reason being is corporations and governments are trying to hedge against their FX risk. And so it's all, you know, your exposure. Do you want exposure to a German bond that's been issued here in the United States? How well do you think that company or corporation can back that bond being over in Germany? Will that international risk give you a higher premium for that?
Yeah, I mean, that's all pretty complicated.
It's all very complicated, but if you ever want to get into international bonds, I'm telling you, it's a lot more fun.
It's more fun? Hey, I mean, that's cool though. I mean, and I'm sure there's like probably simulations and things like that. You can go out and play around with that. So, hey, if you want a fun way to invest in bonds, international bonds.
Samurai, Bulldog.
Is Samurai, is that Japan?
I believe it's Japan issuing in the United States.
I mean, where else would it be, right?
Yeah, but the difference is a lot of, some can, so say Japan invest here, they could invest, in their currency, or they can invest directly with the US dollar. I mean, it's all however you want to see, like, or with Germany, we could have euros being issued over here, we could have USD.
Is Bulldog, is that?
I believe that's Great Britain.
That's Great Britain.
I believe so.
Yeah, I guess that makes sense. What, like British Bulldog?
I'm assuming so.
I like Samurai, makes a lot more sense.
Samurai is a lot easier, but I guess the Bulldog, is their thing. I'd like Big Ben bonds. I think that'd be cool.
That would be cool.
That'd be
cool.
cool.
My name.
Hi, Rick. Word from our cameraman.
Could we call? No, never mind. I was gonna say something that probably should not be in the podcast.
I was gonna say, I can guarantee I know where that was going.
Well, if we want to actually buy a bond, I mean, you just go. I mean, you can basically do it very similarly to how you would.
So there's those primary markets and the secondary markets. Yeah. Essentially, primary markets, you're going to be, odds are not the individual. It's probably going to be a large, other corporations taking on that debt, other governments taking on that debt, which are called large block trades, because they can place millions of dollars quickly and get that debt funded very easily for the company that's trying to raise it. However, there's a secondary debt market, and there's a number of people and sources out there that track this directly to see what bonds are being issued and sold at. And again, like you were mentioning with Wall Street Journal or like Bloomberg, they all track the rates for you, so you can compare and contrast between those to see how or what you should invest in.
So you're saying, like, basically, if you want to buy bonds, I mean, just first go look at the ratings. First go look at what's going on. Like, what are these? So the secondary market versus I guess I don't know, the primary market, the secondary market. So I'm not super accustomed. I don't really know too much about it, but don't put that in the podcast though, because I have to be an expert. No, I'm just kidding. I have to know it all. No, but huh?
Okay, that's not going in the podcast, bro. That's not going in the podcast. I'm not going to be associated with that.
I said it. You didn't say it.
I don't care. I just don't want it in the podcast. This is not a word.
Grandma Latch would be very upset by the MM. Grandmas love bonds, man. That's why grandmas like them. Grandmas are pretty risk averse. Do I call my mom and say, Mom,
I want to buy a bond.
Mom, what do I do? Grandma, and she buys me a piece of paper?
Or do I call Rick Doss's grandma?
Yes. You know why we need this podcast is because when you Google stuff, they give you a million things you don't want to know at this time.
It was actually a good point you brought up earlier, Ben.
Which point?
The part about maturities. We should totally talk about the maturity of the bond.
I think you mentioned maturities, but we want to go into a little more detail.
A little bit about you.
So when we talk about maturities, like we talked about, you hold a bond. So but how long do you hold a bond? Yeah. Well, you hold it until it has matured. Mm-hmm. So, the returns really on that is the yield you receive until maturity, right? The YTM.
If you're looking to capture those continual coupon bonds. However, if you're looking to play, the interest rate game and gauge where interest rates are going, like we were previously talking about between the coupon rate and the actual interest rate, then that's where you might want to sell off early, and that's how the secondary market evolves.
So just like for a stock, how you can hold a stock and just hopefully it grows, and you get dividends, you get appreciation. Just like a bond, you can choose to either play the game a little bit and buy and sell, or you can hold on to it and just hold it and so it grows and you receive those coupon payments, and so the price goes up as well. Yeah. But one thing you have to keep in mind, and as far as like how long maturity, it depends, right? I mean, it could be 10 years maturity, it could be 20-year maturity. I mean, I think, I don't know if is there a cap?
There's a 30-year that's the longest one currently.
Cap.
Yes.
So I mean, the longest you go is 30-year maturity. One thing you have to keep in mind though is that there is something called a call price, or so a bond can be callable. And what we mean really is that when we know that the price of the bond as you hold it can go up and down, a lot of times the organization issuing the bond will set a call price, and basically what they're saying is that if the price of the bond hits this price, we are able to call it. We are able to take it back, buy it back, right? So I don't. Is the convention of call price, is it the par value plus a coupon payment, or is it? I think that's one of the conventions sometimes of how they set the call price. They might just do. But I think they can.
It's a certain threshold that the company sets to ensure that maybe they now have the cash necessary, then they just want to pay it off quicker, so they don't have to pay the holders.
Like they see the trend that it's going up,
it's more in that loan range again.
I think I've just seen sometimes that they use the tradition of doing 1,000, like the par plus one of the coupon, and that's what they set as the call price. But yeah, so that's just something to keep in mind, is that you might not be able to hold a bond until maturity. However, there is limits. So a lot of times it's like after 5 years they can call it. So they cannot call it in that first 5 years. And that kind of helps you out. So it's not like you buy a discount bond, a year later its price went up and they just, we're gonna call it. They can't do that. They have to wait. So it's it's regulated to kind of safeguard against that. But I think that's just something important to talk about in terms of maturities.
Yeah.
Tyler, if I woke up tomorrow morning and I want to buy a bond,
yes,
what do I do?
So essentially it's a very similar mechanism to how we were talking about equity in the stock market. So we're looking at those brokers out there that we have already invested some of our money into, and we talked about that a few episodes ago. And essentially you just allocate a portion of that to these bonds, these lower risk investments, and these what we call deem fixed income investments, and it just becomes and absorbs into part of your portfolio. So if you say you want international exposure, you'll go into international bonds. The broker might direct you in one direction, or you might have a preference as to which country, which denomination of money. And nonetheless, if you want to be in the U.S., is it going to be a corporate bond? Is it going to be a municipal bond? Is it going to be a treasury bond? All these questions, but you can individualize and pick based upon your own preference, and then add that to your portfolio to become part of what you're looking for.
So this really goes back to the kind of how you can really customize your investments, depending on who you are,
and tailor it to your own needs.
Yeah, exactly. And that's so bonds are in that way. Bonds aren't that different from stocks in that you still have a lot of ability to really, like you said, tailor it to what you like. Okay, yeah, that's great. I think we've really covered a lot of good stuff about bonds. I mean, of course, we've also mentioned there's more complicated, versions of bonds and things to look at that way. But in general, they're not too scary.
Not too scary at all. No, not once you start to understand the waters.
Yeah, absolutely. All right, everybody. That was
S-A-T-U-R-T-A-Y. Hey.
All right, everybody. Thank you for watching the Thymble podcast. This was episode 3. We gave you an overview of bonds. We talked about what they are, why you need to know about them, and how you can invest your money in them. Next episode, we're going to be talking about mutual funds, which is one of my favorite things. I think it's a lot of people's favorite things, to be honest. And I'm just going to take you on a I'm going to take you on a romantic date. No, I'm just kidding. No.
Just keep going, bro. Just keep going.
I'm going to take you
on a romantic walk along the mutual fund beach.
In the mutual fund beach. And we're going to go on horses. And don't worry, I'll keep you safe. You're not going to fall off the horse. It's going to be beautiful. Take it easy, everybody.